tell us about the appetite for IPO, because sometimes it's more about growth and revenue, sometimes it's more about profit, sometimes it's more about tech savvy. I'm not sure what this is about.
Well, I think about the game behind the game, and the game behind this game that we saw this morning, which frankly was super exciting. All these things are this great moment of Genesis, so it's super exciting to be part of it. But when you take a little bit of a calmer look at it, see what's going on, in asset management overall, there's so much money going into ETFs, right? We had, I think, $350 billion going into ETFs. And what's one of the provisos that they have about, for a lot of the indices in which they go, that you cannot have dual class listed stock, right? There's a whole range of investors, pension funds, endowments, to say, I don't want a dual class stock. But you know what? Companies like Levi's are able to go public with a dual class structure. And why are they able to do that? Well, because they don't necessarily, well, Levi's might be a bit of a different example, but some of the tech companies, they don't need the money, right? They need the liquidity. So really what you see when I look at the game behind the game, really big changes in the asset management business and the de-equitization of so much of both companies that are buying back stock and companies that are leaving the listings area. You really don't have many options other than to buy stocks.
So are we going to see a sea change here? I mean, I remember when Snap went public and there was all this concern. Snap, Facebook, those are both companies that are controlled by the founder CEO. Right. Lyft, dual class structure. And it seems to be something that, other than Levi's, is really more of a tech company thing.
Yes.
So how is this going to change in terms of investors? Are people just going to get over these concerns?
I don't believe it's going to change. One, because they have the market power. Two, they only need, generally speaking, the liquidity more than they need the money. And three, there aren't that many stocks to buy. Like the Wilshire 5000 is 3,800 stocks. We know that in 2016, 2017, the amount of equity in companies overall was actually going negative. So every day you're putting money in your 401k, most of your listeners are doing that. They got to put it into stocks, right? Well, there ain't that many stocks to go. So I think, generally speaking, dual class structure probably persists.
Jaclyn, what is your thought on whether this is just an open window in the best way in terms of the appetite that investors have for different types of companies with different types of stories to tell in this environment? Or is there a certain type of skepticism that you expect to emerge as we start to see some of these other known brands come to market?
Good question. Well, first of all, I want to say congratulations to the Levi family. I just got to listen in, and it sounds like they're doing great. And I think we're going to see a lot of great IPOs. I think what Levi just showed us is that the American, public is excited for this IPO season to happen. I think we're going to see a lot of really great IPOs. I mean, it just popped 30%. I listened to the CEO, and I think the thing he said the most that stuck out the most to me is their growth. They grew the most they've ever grown last year in a quarter of a century. And Lyft is probably going to do the same thing here next week. People want to keep talking about their net losses, but 80% of companies that IPO'd last year had a net loss. And also 80% of the companies that did IPO last year, they either were at the price target or higher, and usually pop 16% within the first day. So, Lyft is growing. Their revenues grew 100% from 2017 to 2018. They are, by quarter from 2017 to 2018, are growing twice as fast as Uber. I think the growth numbers speak volumes for companies who want to go public, and I do think you're going to see a lot of great IPOs coming down the pipeline, and investors are excited about it.
But I guess that's the question. I'm looking at estimates of 234 companies targeting 2019 IPOs with a valuation of nearly $700 billion. Is there a question of capacity? Bob Pisani talked about this earlier. He said that the companies that are first to market are going to do better just because of the issue of demand. Is that going to be a problem?
I think there's always that concern. I do agree with him. I think if the sooner you get out, the better, right? Because it's been 4 months since there's been an IPO, and so people are really ready to put their money to work and see these companies succeed. Not every company is going to be able to sustain their valuation. That's why companies have to continue with their vision and growth, and I think that's one of the reasons that these tech companies do the dual class structure. It allows the founders to really focus on building their brand and not being worried about hostile takeovers or market volatility. it'll allow them to really focus and continue to grow their business. And that's what you need to be successful and maintain and hold on to the valuation.
Best of both worlds, public capital and your own rules.
Well, this is what we deal with every day. So, we do shareholder advisory for companies, and what you see for so many of the public boards and managements is they are become, I don't know, deathly afraid, but certainly incredibly sensitive to what activists in the market are doing. So the current Bristol-Myers situation, to veer it a little bit afar, is an incredible moment for this reality in which shareholders have voice in what goes on at companies. So if you see that reality now, and you have the opportunity to have a dual class share structure, and the market will still give you its money, I think the conditions are right for more of those. But it's all interrelated between asset management, ETFs, activism. Shareholders have more voice, and if you can put up a wall, perhaps to give them a little less, you'll do it.
Yeah.